personal finance.
So Warren Ingram from Galileo Capital, he's a financial advisor. He's the director at Galileo Capital. You're getting lots of questions from grumpy people who are looking at their statements from their unit trust companies, and they're saying, there's been no growth, or there's been very little growth in my funds. And you've gone and done some studies, and you've gone and done some tables, which you very kindly provided to us. I mean, over a year, most unit trust funds are going to be in the red.
They're already in the red, yeah. And it's interesting, when you talk to people, I think they can handle it for a little while. I think we've done a good job on this show telling people, it's long term and maintain perspective, etc. And so they buy the argument, but the moment it goes for slightly longer than their sense of comfort, you find that they start to disbelieve the long-term story, and the conversation goes around. I've seen adverts in newspapers for banks that are offering 9% guaranteed interest on a fixed deposit, and my investment's going backwards.
Now,
good question.
If somebody had taken 1,000 rand and put it into a fixed deposit this time last year, they would have 1,000, and they would have 1,090 rand. If they'd taken 1,000 rand and put it into a general equity fund, they'd have 970 rand. They'd have less.
Yeah.
Like $100 less. So it was a good idea 12 months ago, if we'd known, to put it into a fixed deposit.
100%. And that's the wonderful thing about investing in the rearview mirror, is that it's such an easy science.
But that's also where people go wrong when it comes to investing, because they look at now and they say, but if I'd done that, I would have been better off. And then what they do is they take their money, which has not grown over the past 12 months, so it's worth less technically now than it was then. They take it out of that unit trust and they then pop it into a fixed deposit. And I think the pattern is there over decades.
There's a brilliant study that gets updated quite regularly in the States by a company called Delbar. And what they try to understand is this thing called the investor behavior penalty. The behavior gap is the summary. In other words, you look at what the world of investments do, what do unit trusts do, and then you look at what actual investors are achieving from those unit trusts over a 5, 10, 20, 30-year period. And typically, investors cost themselves about 3.5% a year as an average. In other words, if unit trust, let's just say unit trusts that invest in shares, the jargon is general equity unit trusts, give you 12% a year, the average unit trust investor in those unit trusts gets worse than that. They're getting 8.5% or 9.5%.
Yeah, roughly
8.5% percent a year from those self-same unit trusts. And it's not explained by costs, because the costs are built into the unit trusts already. And it's exactly what we're talking about now, because they remain patient for a period of time. And then at some point, they lose patience, they look at what's happened in the past, what's done well in the past, and then they make that investment decision. And unfortunately, what they do, and it's interesting because we do it en masse as investors, is we typically make these huge investment decisions right before the cycle turns, right before the general equity, if we're talking about shares at the moment, that market cycle turns, we move out. And we go into the fixed deposits, we get our 9%, just as the next year, the general equity funds give us their normal return, which will be around about 13 or 15% a year, and we lose out on that growth. And now we're locked into a fixed deposit. So we're there. We can't get out. We're paying tax.
Yeah, and that's the real risk. I mean, I'm just looking at, you've got three categories of unit trust that you've looked at. The general equity unit trusts, and this is a fund that every unit trust manager has a general equity unit trust, and their job is to take 100% of your money and to put it into shares. They can keep a little bit in cash, but generally it must be fully invested in shares. And over the last year, general equity funds on average are down 3%.
So just to give that a context, if your unit trust has then just stayed flat, your general equity fund, or it has lost you a little bit of money, so I would say your range would be minus 5%. So if you've lost 5%, up to let's say 1 or 2% as a positive return from a general equity fund, and you're really irritated with your fund or the advisor that put you in that fund, just understand that's really what's happened. That's really the context of the markets, and the markets are much like a tide. If the tide's going out, no matter what, your investment's going to go out with it as well.
Now, balanced funds, which are supposed to be far less risky, where the fund manager is then expected to do some real work and is supposed to take a proportion of your money and put it into bonds, and put a proportion of your money into property, put a proportion of your money into shares, and keep a proportion in cash. If they have a lot more flexibility in terms of what they can do with their money, they're flat at best. Over a year.
Yeah, and so exactly. I mean, the average is slightly negative. So again, it's what the universe of those funds have done, and you just need to understand that.
But I would expect more from a balanced fund. I would expect a balanced fund to be able to take advantage of negative environments, which hit general equity funds far more.
Well, so just to understand the category, that category means that their range of allocation to shares would be somewhere around 40% or so at the minimum, up to, let's say, 75% at the maximum. So it's not a flexible fund where they can go 100% into cash, for example. They are always obliged by their mandate to have a reasonably high allocation to shares. So if your fund has, whatever XYZ company balanced fund, just understand that that universe of operation probably is giving you around about zero.
Okay,
but this is where it's interesting. Now the world gets turned on its head. So we would say if you're investing in a cautious fund or a stable fund, that's the lower risk.
What's typically in a cautious or a stable fund? Because these terms mean nothing.
About 35% in shares. That's
so
really
mostly then there's more cash, which is in the money market, and it's drawing an interest rate, and that helps boost the returns in a low share growth environment.
And they have quite a high allocation to bonds and then also property.
Okay.
Now, what's interesting is the bond market has reasonably been the star performer over the last 12 months. So it's an unusual time where the bond market is really doing well relative to shares, et cetera, et cetera. So your low risk funds, in this case, they're always called the cautious or the stable funds. Those are actually outperforming. And that's an unusual situation to be in. And what we need to know is when we're sitting in unusual situations, don't extrapolate that in your mind to say, well, this is now the new normal. This is how things are going to be. Your cautious fund, if it's done well done. You've benefited from that. And I'm not saying it's done brilliantly, because the likelihood is you've probably got about 3%. We're not even keeping pace with inflation.
But that's the point. I mean, if you put 1,000 Rand into the market last year and you got no growth and your unit trust statement still reflects 1,000, it's actually worth 6% less than it was this time last year, because inflation has corroded that nominal amount of 1,000. Now you've got a decline of 3% in a general equity unit trust, plus in the inflationary impact of 6%. In real terms, your 1,000 Rand today is worth what $900 was worth this time last year.
So now I can imagine someone sitting in the car listening to us and they're going, that chop on the radio is telling me that that's okay.
No.
And I'm saying it is okay.
No, it's not okay. It's okay, but it's not okay.
It's not okay to lose money, and it's never comfortable, and especially when you take into account the real return, the impact of inflation on your money.
You want your unit trust to give, if you give them 1,000 Rand today, you want in a year's time to have 6% more than that 1,000 Rand today. You want 1,060 Rand at least by this time next year, because that means your money is worth the same. At least you're standing still.
Yeah, you're actually running and you're standing still.
Yeah.
And that would be great. That would be the best way to invest. If we could all invest our money where things just moved forward in a sensible direction, plodded along, and 1 or 3 years later we were getting our returns, we'd all be happy. Unfortunately, that's not how it works. Investing, if I had to draw a picture, it would look a lot like a roller coaster ride.
Yeah.
It's going to go up and down, up and down, up and down, and you need to be really comfortable that the downs are going to happen, and we are there now.
Okay, but I look at even a balanced fund, which is sensible and it's quite cautious. Over 3 years, you've got 6.5% on average every year.
You're just standing still.
So your 1,000 Rand that you invested 3 years ago is still worth exactly the same amount of money as it was 3 years ago.
It's buying what it could buy 3 years ago. And that's the point. So what's going to happen, and unfortunately that's the difficult part in this whole thing, is at some point, if you remain patient, that the reward for your patience will come. It usually comes in quite a big lump. It comes, all in 12 or 18 months, and it comes very suddenly. And
so your message is don't panic. Don't go and do something stupid.
Agreed, and also just understand the context of what you've got. And I think we are in a really unusual time. I after I'd sent you those numbers, I sat and I thought, I want to give a 5 and a 10-year context just to show how wonderful the returns are. And in fact, everything from these cautious funds to equity and high equity balanced funds, everything's done pretty much between 8 and 10% a year for the last 5 and 10 years.
Yeah.
We are in a really unusual time, and I think that kind of stagnation which we've got now, it does unlock.
Does unlock?
It does unlock, and we get rewarded.
DK Mudao, DK, thanks for your tweet this evening saying, by the end of September, I received my third quarter statement of my unit trust. The NAV looked satisfactory compared to the inputs made so far. So DK Mudao is happy. Tony, is it Sandby or Sandy Bay? Where are you phoning from, Tony?
From Sandby in the Cape, yes.
Sandby, not Sandy Bay, so you've got clothes on.
No, not Sandby, not Sandy Bay, no.
Okay, good, just checking.
Good evening, Bruce and Warren. A question for Warren. I changed from the general equity fund to international feeder fund, especially as a result of the Nenegate story. And it's way down. The international feeder funds are not performing nowhere near what they were last year. And what is the reason for that?
Great question. Thank you, Tony. First of all, so we've established what a general equity fund is. What is an international feeder fund?
It's a rand-based fund, but it invests entirely in the international markets. And often they'll look very similar to what we know here. So you can get an international fund that's a stable fund. You can get an international fund that's a balanced fund, or pure equity. And Tony sounds quite young. So I imagine he's probably in an equity fund, but it's a rand-based overseas one. So it's investing in a range of international shares, but it's priced in rands. So it's converting your rands, let's say, into dollars. And then when he sells it one day, the dollars will be sold and he'll get back converted into rands, and he'll get his rands back.
So if he'd taken 1,000 rand this time last year and had put it into and bought dollar assets, he would have looked very clever while the rand was losing value in the first 6 months of this year and would have felt great. And then in the second 6 months of this year, as the rand retraced its lost ground, you would have felt less clever.
So I'm just thinking post-Nene, if I remember, the rand it was very high 17s, close to 18 to the dollar. In my mind, I don't know why, but I think it was very, very close to 18. So if you imagine...
18 to the euro, 24.51 at its worst to the pound in January, 19-ish to the euro, close to 18 to the dollar. Doesn't matter.
And that's the point. So even if we look at where the rand dollar is today, roughly 14, that explains a big proportion of why those funds are not doing well, is just the rand has actually got stronger against all expectation.
And now the problem that Tony has is he looks at the underperformance of the last 12 months, and then he sells these international feeder funds and then buys back into South African general equity, because that's what human beings do. Would that be a mistake?
No, that would be a mistake. That's exactly what you've now unfortunately had an unfortunate timing issue now, but now you stick it out, and always, the funny guys would say, a good long-term investment is a bad short-term one. So you've unfortunately made a bad short-term investment. Stick it out, be patient, and you will be rewarded for your patience over time. But I wouldn't be surprised if the South African market does quite a bit better than international markets. I'm terrified as to what's going to happen in Europe. I don't understand what's going to happen in Europe in the next year. Whereas at least here, things are sort of muddling their way forward.
We can understand our own crisis. We just don't understand other people's.
Exactly. And I think their crisis is a lot more difficult to understand than ours.
There we go. Warren Ingram from Galileo Capital.